Well, thank you, Ambassador Park, for inviting us all here. It's certainly an honor, and it's a double honor, too, to follow Ambassador Negroponte and also the chair of the board of the Korea Society, Ambassador Hubbard, and to benefit from their experience and wisdom they've gathered from that experience over their long and distinguished careers as diplomats. I'll take a somewhat different tact here, and I'll make some observations on Korea's economy and what are the greatest influences on Korea's economy. Where I thought I would start out is particularly over the past 6 months, but even longer, over the past year and a half. There's been a disconnect, I think, between the concern that diplomats, political observers have on the situation on the Korean Peninsula and how the investors and markets, particularly international, look at the situation in South Korea. We all know that there tensions between military tensions on the Korean Peninsula are at a very heightened level. Ambassador Negroponte characterized North Korea as posing a grave threat to South Korea in the region. And there's just a lot of pessimism out there, but yet there's still a lot of optimism in the markets. So that's one of the overall observations I have, and I'll go into looking at this a bit more closely. South Korean economists, and I think the public at large, because the public seems to be more in tune to what the national economy is doing in terms of GDP growth than it is, say, in the United States. I know that from asking my students at Columbia and also Georgetown, whereas really a lot of the students have only a vague idea of what GDP growth is in the U.S., whereas the Korean students have a very precise idea on what GDP growth is in Korea. At any rate, the big debate here, I think, in Korea, why can't the Korean economy grow at 3% or greater, which actually historically is still a relatively modest pace of growth in Korea. And my answer to that, really, it has nothing to do with the North Korea threat, despite the heightened concerns, although risks are creeping into policymakers' considerations. So with that, let me take you through really quickly this slide. I just find it unable to talk, as Ambassador Negroponte did and Ambassador Hubbard, without numbers behind me when I talk about economic issues. Okay, so how do I do this? All right. Yeah. So if I can just drill down a little more. In the case of Korea, global trade and structural rigidities are what weigh on South Korea's growth. The risks in the system are household debt, financial risks, I should say, and concerns about China's growth. As I said before, North Korean geopolitical risks are low, but perhaps edging up. Policymakers in South Korea now identify two new risks, China and the U.S. in terms of trade, and potential downside risks, I should say. However, Korea has what economists call ample monetary and fiscal policy space to deal with challenges, economic challenges. And in a sense, Korea plays a stronger offense, its economy, defense rather than offense. Something happened back in 2011 and 2012, an inflection point in the Korean economic performance, whereas before the global financial crisis and shortly afterwards, Korea is the blue line, the global economy average growth is the black line. Korea grew faster than global growth, but that is no longer the case. And I'll go into these reasons, and maybe the panel can also revisit those reasons. But you can see that Korea is now tracking slightly under the world growth rate although still doing considerably better than the advanced countries. But as we know, the advanced countries post-global financial crisis, growth has been very anemic in the United States relative to historical growth, Europe as well as Japan. Japan for a lot longer, actually. And I think the main reason is that global trade growth has collapsed. These figures are based on a 100 index where anything greater than 100 means trade growth is higher than the previous year. So the black line is again, the global growth in trade. The turquoise line, or maybe light bluish, celadon, I'll call it a celadon. The celadon color line is China, okay, and then the blue line is Korea, the light blue line, and so Korea grew close to the world trade growth pace up until about 2011, and then it kind of slipped off. Well, actually, it followed the collapse in world trade growth. China, the celadon line, kind of defied gravity for a little while, but not any longer. And I think this is probably the primary reason why Korea's growth has slipped below 3% in recent years. The Bank of Korea's latest forecast, by the way, expects global trade growth to accelerate above 3% per annum. But yet, they do not forecast that Korea's growth will go up that high. They still think it will be in the high 2% range. And we see this, how Korea is so deeply affected by global trade, in that of these advanced countries that are on the slide, Korea's exports play a bigger role in economic growth than consumption, personal consumption. In a sense, that's why it's hard for a Keynesian economist, policymaker to be successful in Korea. It really depends on external demand and not internal demand or domestic demand that drives growth. Germany comes close, but still in Germany. Korea is of course, the two bars on the closest to the y-axis here, y-axis. And the U.S. and Japan, continental economies, in effect, it's really consumption that is the biggest influence on the economy. Now, I think one reason in this era of low global growth and demand for goods, merchandise goods, is that Korea has to rely on its services sector to a larger extent for growth. But yet the services sector in Korea has very low productivity. This is an area, a structural reform area, that I think needs to be addressed if Korea is going to increase its GDP growth potential. The IMF has done analyses and studies where they think that if the services sector reform is successful, that the potential growth rate in Korea could go up 0.25 percentage point. Several years ago, they actually said that in addition to other reforms, you'd get a 1 percentage point increase in potential growth. So therefore, Korea could grow faster than 3% per annum over the next 5 to 10 years. There's a lot of concern about youth unemployment in Korea. However, I know this slide is very hard to read, but Korea is, I don't know if you can see the celadon or the turquoise line over there, and I'm even having a hard time reading this. The OECD total is the black. So Korea is in the low end of the range of youth unemployment. France is the purple line, I believe, and of course Greece is the second to highest line, where there's just massive problems in Greece. So relative to other OECD countries, Korea is not so bad, although perhaps 10% growth is a bit, unemployment is a bit high, and policymakers should do something about that. We know that President Moon is interested in increasing public sector employment to address part of this problem. I believe the bill is still stalled in the National Assembly, though. Turning to systemic financial risks, the top chart, this is the most recent financial stability survey from the Bank of Korea. The top panel shows the risks cited as the survey takers citing this particular risk as the greatest risk that the financial system faces, and it's household debt at 30% of respondents identify that. You can see there's no North Korea risk here, geopolitical risk. In fact, China drops out as a top risk in the 2016 financial stability report by the Bank of Korea. The bottom panel shows risk factors cited, although not perhaps the greatest risk. Chinese growth slowdown is in there, but again, household debt. 70% of respondents are very concerned about the household debt problem in Korea. Again, nothing geopolitical here. I just thought I'd share with you the 2015 survey by the Bank of Korea. 2015, when this survey was done, there was great concern over whether China would have a hard landing. There was a lot of monetary exchange rate instability in China at the time. Botched exchange rate policies on the part of the Chinese authorities. And here you see that 90% of responses cited Chinese economic slowdown as the greatest risk. U.S. interest rate normalization is a risk for the whole global economy, as well as the U.S. economy. And the household debt problem is still in there, although the respondents thought this was not an immediate problem, but something that could be a problem over the medium term. Just focusing a little on the household debt, I think the reason it hasn't destabilized the system yet is the good part of the story, but there's a good and bad and ugly aspect to the situation in household debt. Since I mentioned the good first, the good part is that in the right panel, household debt to financial assets is actually relatively low. It's less than 50%. So households have a lot of cushion in terms of financial assets to deal with their debt. The bad part is that I think household debt to GDP ratio is relatively high. This data is several years old, but it was about 150% of disposable income back then. And the ugly part is the left-hand panel, where you see the blue line, the bars show this inexorable increase in household debt. The line shows a very high increase in household debt. So we can put this whole thing into perspective, these aspects, into the OECD perspective. Again, like youth unemployment, Korea is not so bad compared to other OECD countries or advanced economies. Korea is a red line. Household debt as a share of disposable income is much higher in Netherlands, Denmark, even Singapore. But Singapore, there's so many. It's a special situation. And but yet Denmark and Netherlands are relatively stable systems. So I don't see any major risk, at least over the near to medium term, with Korea. But it's something that's weighing on GDP growth and keeping another factor in keeping GDP growth below 3%. I'll pause at the household debt discussion and answer Ambassador Park's question on China. Okay, dispose of this. Why did Moody's downgrade China? Now, of course, I no longer get a paycheck from Moody's, so I can't tell you exactly why, which is probably good, because if I did, I could only tell you what's in the press release. But I can still tell you the problem in China is that China, the state sector in China, not so much the government, but the state-owned corporations, have relied on debt for too long to sustain output and growth. And now state-owned corporate debt in China is really at an alarming level, historically speaking, and also compared to experiences in other countries. The relatively rapid growth in debt, the long dependence on on debt-driven growth. This actually reminds me of a situation in the Scandinavian countries in the 1980s, where all of them had fiscal crises. China, the fiscal crisis will probably be deferred because the savings rate is so high in China. Also, the debt is all in local currency and held by domestic banks, and the domestic banks are controlled by the government, so the government will have regulatory forbearance on questionable household loan assets. However, the way things are going in China, some sort of fiscal problem, if not crisis, I would say has a high probability. So that's my answer to your question. Okay, now I can turn to Korea. So what do I mean by Korea plays a good defense? Its economy has a good defense. Well, in one sense, it's a strong fiscal fundamentals. It has relatively low debt. So Korea's debt is less, the government debt is less than 40% of GDP. Similar to China, which is on the right, all the other countries, Italy, even the US, including the local governments, it's 100% of GDP, close to France. All the other governments are much higher. China, the debt that I'm talking about is in the state-owned enterprises. And so that would push the debt much closer to 200% of GDP, so much higher than Italy's, for example. So this is one aspect of Korea's strong defense, low government debt. Another is that because of the low government debt, the government doesn't have to go out into the market and borrow a lot of debt. That could be very dangerous when bad things are happening that would spook investor confidence, and therefore the government might have to pay more money, a higher interest rate on their debt issuances, on the KTBs, to sell the debt than they would otherwise. Korea is strong. The refinancing requirements as a share of GDP is, I think, something like 4%, as low as Switzerland, which is rated AAA by the rating agencies. This is an IMF source chart, so these ratings probably come from another rating agency than the one I worked at. So I see they're a little different. But at any rate, you can see that the U.S. has a much higher gross financing need. It has to finance a budget deficit, plus roll over maturing debt. The U.K. is in the same boat, so is Canada. Even Germany, very solid creditworthy economy, has a higher gross financing need than Korea. So this is really a very important strength of Korea, a very important defensive strength of Korea. And so how's this reflected in the market? In the market, this comes from just a couple of days ago, the Asia Development Bank Bond Monitor, where it has a neat comparison of all the regional bonds plus the U.S. So the 10-year treasuries for the U.S., the yield is 2.332%. Korea is the KR in the middle. It's 2.247%. So it's trading tighter than on the secondary market than U.S. treasuries, in one sense implying a lower credit risk than the U.S., but I think also reflecting some other factors such as the relatively weak growth expectation for Korea, and that tends to tighten bond yields. Note that the government debt in China and government debt in Korea is about the same level as the share of GDP, but yet the Chinese government has to pay 100 basis points more to sell its debt in the market. So again, a notable defensive strength of Korea. Another defensive strength of Korea that Korea developed after the global financial crisis in 2008 was that it has accumulated a large amount of net assets in its countrywide balance sheet, the central bank, the government, corporations, households, and it's equal to $236.5 billion at the end of the first quarter of this year. That's a left-hand panel. Whereas at the darkest moments of the U.S. recession and pre-global financial crisis, it was a negative $213.9 billion. That's a remarkable recovery. In fact, as a share of GDP, Korea's net international investment position now is greater than China's because of China's corporations' debt, dollar debt binge that they've gone on in recent years. And the reasons for this, when you look at the assets and liabilities, is that Korean macroprudential regulations, as well as better risk management by banks and by some corporations, have contained external borrowing. Korean corporations did not really go on a borrowing binge when interest rates were really low in the U.S. market, and have accumulated assets over time and in recent years. So turning to the risks, this is the most recent Bank of Korea Economic Outlook. It was just published just several days ago. And if you were to look at these economic outlooks and go back 2 or 3 years, the downside risks are actually, 2 of them are actually pretty new. One is trade, China THAAD economic retaliation. And so these are potential events that could drive the economy down, increase financial instability. And the other is a U.S. FTA possible renegotiation, or the disaster scenario that Ambassador Hubbard talked about was that everyone just walks away and the treaty becomes dead. So that would have a definitely negative effect. But even, I think, prolonged negotiation or amendments would probably negatively affect business confidence and therefore investment in the Korean economy. And that would be another, I think, another factor weighing on the Korean economy's ability to grow by more than 3%. The second risk, financial conditions acceleration of U.S. Fed monetary policy normalization. This is an ongoing risk, nothing new. Probably not something that the Korean system has to worry too much, because it looks like the Fed will be very cautious and gradual in normalizing its monetary policy. And the third is something new, relatively new, where confidence in the Korean economy could be affected by North Korean saber rattling, more nuclear tests, or more ICBM launches, something like that. The Bank of Korea also has its monetary policy statements, and the most recent one where it kept its interest rates unchanged. And it went through the top 4 are the typical risks that are cited, except the second one, where now South Korean policymakers are concerned about the negative effects of China and also potential negative effects of the U.S. I should say that the negative effects on China are already affecting the economy. President Moon, in his speech at Georgetown, not Georgetown, but the CSIS in Washington, D.C., mentioned a figure that China economic retaliation has damaged the Korean economy to the tune of $8 billion. And that will continue if China continues to, in effect, de facto ban group tours of tourists coming to Korea, lean on latte retail stores very heavily in China. And if somehow the drop in Korean motor sales in China is due to economic retaliation, political reasons, rather than for market reasons, there is probably also contributed to the drop in auto sales in China, is that some Korean car makers have not kept up with market tastes for certain types of cars. But this will have an effect on Korea because, as we saw before, Korea is so heavily dependent on the economic performance on external trade. So this will have a negative effect. But the last risk is the one I'd like to highlight. And now the Bank of Korea cites geopolitical risk as something that they're monitoring. Now, when I went back and looked at the policy statements by the Bank of Korea, the first time I noticed, I didn't have a fact checker on this, so I say that with an asterisk, is that the first time I saw this language used was in February 2016, immediately after the 4th nuclear test by North Korea. So these are potential risks coming from North Korea. What has actually happened over the years? This is a chart I borrowed from my former employer, Moody's. But the top line, the light blue line, shows the triangles or provocations or saber-rattling incidents. And it's also the COPSI stock market index. And it shows that no great drop in the stock market index. When you drill down, I had an intern this summer at the Korea Society look at this much more closely. The story is that the stock market may drop immediately after one of these tests, such as the July 4th ICBM test or the 5th of the 4th nuclear test, and stay down for 4, 5, 6, 8 days, but then recover. Now we know other things are going on in stock market investment, but the immediate effect of the test, which is usually a couple of tenths of a percentage point in terms of overall stock market volatility, is wears off within a week or so. Another thing is that the low point for the period, the year period before and after the test, the low point in the stock market, did not coincide with the North Korea nuclear test or missile test. It occurred for other reasons, economic, financial reasons. So there's been no great effect on market sentiment yet from North Korean provocations. The darker sell it online is the KTB yield. If it's going down, it means there's less risk priced into government bonds. So I think that the KTB is still a safe haven, despite the North Korean provocations. However, that being said, those are market indicators. Now this is looking at how some investors view the geopolitical risk in Korea, looking at CDS spreads. Now that's credit default swap spreads. And so what these investors are doing is buying Korean assets such as KTBs, but yet also hedging them, insuring them. And so the cost of insuring a KTB has actually risen this year. January 2017, according to Moody's estimates, they do a more sophisticated estimate than just the CDS price. The dark blue line has edged up, and it's a left-hand column to above 0.16. So that's an expected default frequency. One would be where you should really expect default. And so that's edged up in recent months. And the Moody's, this is from the capital markets part, not the sovereign part of Moody's, believes that this is really the domestic political uncertainty coupled with the geopolitical uncertainty that is causing some investors to think that they have to insure against a possible default, even though they're still probably buying these assets, these KTBs namely. Now, let me put that in perspective with other countries, other hotspots in the world. And what you see here is that the purple line at the bottom, I'll finish in 2 minutes. Okay. The purple line at the bottom shows that the risk in Qatar and Saudi Arabia has increased greatly, and in fact is much higher than the perceived risk of South Korea. So the insurance premium on instruments issued in these countries is much greater than Korea. Turkey is at the top there, where it's very risky and people like to be insured. So I don't need to go into the chorus FTA scenarios. Ambassador Hubbard did a really good job on that. Other than termination, Article 24.5, I think would be, to use a Trumpism, a disaster for the Korean economy. It would really keep growth below 3% a year, I think. So lastly, Korea's economic outlook and financial risks are manageable with continued policy prudence, efforts to improve industrial competitiveness and trade openness. North Korea geopolitical risk remains, that's a typo, remains latent, although it is edging up. And I think a strong, well-coordinated and credible ROK-US alliance will keep geopolitical risks low, even with continued North Korea saber-rattling. So thank you.